Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Very excited for today's show. We've got Mike Angelo on the line with us. And why I'm really excited about this is Mike and I have been working together on a project in Tulsa that is well on its way to profitability. So that said, Mike, welcome to the show today.
Brian, super stoked to be here. Thanks for having me.
Absolutely. So do us a favor, tell us a little bit about yourself, where you come from, and how you got into multifamily.
Absolutely. So been in the multifamily worlds for about 5 years now. I'll go back a little further just to give everyone a little bit of clarity. I spent 20 plus years in the construction supply world. So in sales, B2B, calling on contractors, designers, all that kind of good stuff, selling products. And my first dabble in real estate was single family flips in 2007. Paid attention to the timeline.
You picked a great time to start flipping.
Perfect time flipping. Listed the house, finished it, overspent on the budget, and of course lost money. And so if you talk to my wife today, she'll still feel a little bit of a little grind on that one. So
just to remind you of it.
Just a little reminder. So that was 2007, 2008. Went right back to the corporate world, and my goal is to climb that corporate ladder and be CEO of said company. And I really worked for 3 companies in that 20-year period. So it was really trying to move my way up and drank the Kool-Aid, loved all that good stuff, but quickly figured out how am I going to build wealth for myself, my family, and started listening to real estate podcasts at the really kind of middle of 2019. So fast forward 2019, I'm running a pretty large division of a construction supply company and lots of great responsibility, but I was burned out. I actually had, I'm 46 now, so this was 41-ish. I was having chest pain and stress, had to go to a cardiologist. And, that kind of stuff runs in my family. And so he's like, you're healthy, but your job is terrible. You should quit. So cardiologist says, I can put you on meds or you could quit. And so that kind of put a bug in my ear of what do I do, right? Or so he says switch jobs. He didn't say quit. And so found a podcast, Whitney Sewell, LifeBridge Capital.
Yeah.
Love that podcast, and just didn't know anything about syndication, didn't know anything about multifamily at all. I always thought the big corporations own apartments. And so had a little bit of capital, found a deal that they had going, invested as an LP.
Nice.
It was great. Almost, within 3 months, we were starting to receive distributions. So I told my wife, I'm like, this is kind of cool. And then the writing was on the wall with my company that there was going to be some changes and there's a high probability I wouldn't have a job. And so right at the end of 2019, I got the notice and, got a nice severance package. And I just told my wife, I said, hey, we've built up enough savings. I need a year and a half runway to go do this thing, multifamily active investor. I don't really know exactly what it is, but give me some time. And I said, if it doesn't work in a year and a half, I'll go get a job.
Yeah.
And so she was having a supportive wife was huge. So she said, go for it. And that's what we did. Of course, March 2020, COVID hits in and everybody knows what happened there. But for me, it was actually an amazing time because all I did was underwrite, call brokers. I'm based here in Phoenix, Arizona. So very hot market, learned a ton of stuff, signed up for a mentorship program. I do recommend if you're, looking to jump in, get educated because I knew nothing about commercial real estate.
Yeah.
So dove in, fast forward to 2021. So it took us a full year and change to get our first deal closed. 1,000 deals underwritten at least, probably hundreds of offers and one accepted, right? So that was great. That was our 60-unit deal, about $5 million. We raised our own capital, did a syndication. And today, fast forward to today, 2024, we're at about 670 doors, a little over 80 million in assets under management. Got a great key partner. And then, of course, we partner with folks like yourself, depending on the deal, all across the Southwest. So based here in Arizona, we own in New Mexico, Texas, and Tulsa, Oklahoma.
Awesome.
Yeah.
Well, let's dive in a little bit more. I mean, you got a notice, which in a way is probably fortuitous. You end up with severance instead of quitting and getting nothing. But let's talk about kind of some of the challenges you had up front. I mean, you mentioned the numbers. I think most people are underwriting hundreds of deals before they find their first one. But let's talk about some of the challenges you faced up front and how you overcame those.
100%. I think the first thing is one, trying to do it all, right? So didn't have a whole lot of capital. And I think if you're looking to jump into the space like I was, either you're going to be an experienced partner, you're going to bring money, or you're going to find the deal. And so the lowest kind of hanging fruit is finding the deal, which is probably the hardest thing to do, right? It doesn't take any money, but it takes a lot of time and effort. So kicking tires. I think my background in sales helped me connect with brokers and really create relationships. But the underwriting process, I used an underwriting tool that was frankly way out of date. And so this, right, Brian? So, looking at certain markets and certain cap rates, if you're trying to shop where the metric hits a certain, call it a 7 cap, In
Yeah.
2019, 2020, there was nothing selling for 7 cap in Phoenix, right?
Right.
Maybe in Mississippi, right?
Yeah. Some of the Southeast states in that time frame,
Yeah.
you may have seen 7 caps, but yeah, we were buying mid sixes at that time in South Carolina.
Yeah, and here everything was compressing in the fives and fours, and so
Mhm.
there was a disconnect with me finding deals that made sense that fit the bucket, and so that was a big frustration. And finally, kind of opened up my eyes to say, hey, maybe I need to look in a different market, right?
Mhm.
Which is kind of one of the things they teach us. So hey, it doesn't have to be your backyard. Go to Texas, go to Oklahoma, go to New Mexico, and we ended up in New Mexico and found a great deal that met the criteria. Got a sponsor. That was the hardest part too. Is you can't just go sign on a loan, right? The bank's
Mhm.
going to want some experience. So we found through the mentorship program a great sponsor. And then Michael, my partner, and I, we basically, raised the capital. It was about 2 million bucks and got it done. And that journey was so painful, but I'll tell you, it was the best way to build a muscle.
Mhm.
I think you just said, right? Some people write 100 deals and can't find a deal. I wrote over 1,000 deals,
Yeah.
find the one.
Yeah.
So
Now, I would say for newer people and for anyone listening, I would say your first probably 20 to 50, depending on how good you are at numbers, are kind of like the throwaway deals. They're kind of like the learning how to use your underwriting template, learning how to underwrite deals, but it still takes a lot of reps and sets on both sides. Underwriting, the entire process takes reps and sets. Now, you say your first deal, you guys raised 2 million. Was that just you and other Mike?
yeah, Michael and I. So my partner's Michael Wagman,
Yeah.
and yeah, we were friends, family. It was a
Mhm.
506B first raise. Of course, we had a database of our own community, and very few of those people actually invested. So it was reaching back out to finding folks that we had relationships with, but through referrals, we were able to get that done, and that was in May of 21.
Okay.
So
What were the biggest challenges you had with that capital raise?
I think just the fact that it was our first one and that we're really relying, we have no credibility. I think the credibility is somebody knows us, right? There's that know, like, and trust kind of triangle, right? Some people knew us, they liked us, but they didn't trust us in this space. And so it was more of, hey, I'm leaning on the bio and the experience of our key sponsor that
Mm-hmm.
has been doing this for 25 years.
Yep.
And you know me, you know what I've been doing, you know my integrity, but am I capable or competent to run an apartment building?
Yeah.
And selling that as, hey, this is a business you're investing in, and that it runs like a business with someone that has that experience. That was one of the harder things to do. We got it done, but we still use that same formula, right? Is, hey, now we're running a $200 million deal, or we're in development, so we're doing a $50 million ground up project. Well, Mike's never done that. Well,
Mm-hmm.
my developer has, right?
Yeah.
So leaning on folks' experiences, I think easier said than done.
And when you talk about bringing in that sponsor, that key principal, they're very interested in making sure that property, doesn't lose money. I mean, some of them are more interested in profits, but they all agree on one thing is, they don't want to lose money. They don't want a foreclosure on their hands or anything like that. So, I mean, they do jump in and get involved. And, we've been sponsoring a couple deals and we jump in and get involved when we have to as well. But it's the same for a lot of people. Just kind of reiterating what you're saying to people listening is you got to partner with somebody on that first deal until you can stand on your own merits in this industry. You've got to partner with people that can. So that's huge. That's
Yeah,
huge.
and the other side of it was property management. The
Mhm.
third partner, right, is
Yep.
who's going to run this thing. And so we were fortunate, created some relationships in the last over that year and a half of underwriting and sending deals through. We found a great partner, and they've still our partner today, almost 5 years later, executing. And
Nice.
that's the big thing is key sponsored, kind of guiding you.
Mhm.
We run really the investor relations side, and then asset management, and then the PM obviously is running the boots on the ground. So
The property manager is huge. That's a really, really key component. And I mean it's really nice. I had a call on a property we just closed 2 weeks ago, and you show up on the call saying 3 vacancies, two of them are leased, and one of them has 3 showings today. If you can show up on calls like that, you're like, this is easy.
okay,
But
yeah, you get
uh,
spoiled.
yeah, spoiler alert, it's never that easy.
Right.
That's yeah, if they can keep doing that, that's a property manager I never want to get rid of. But it is tough finding the right property manager. So good. Glad you guys found one and were able to stick with them. So
Yeah, and we've had other ones where we've had to switch, right? So it's they make or break your property. And I think you can get a great deal on paper and ruin it by bad execution, and
mhm.
vice versa.
Yeah, that's one thing that I think a lot of people, coming into this game don't realize that it does take work managing the managers. Quick story from literally last week. I'm a sponsor on a deal in Houston that right now is slightly below the break-even occupancy, so we've got reserves and everything, and so that like we're pulling money out of the reserve account every month. And so we started just going over with the team, making sure things were done right. And it turns out that they're being told it's being advertised on 8 different sites, and it's not. We couldn't find the property on any site, and they're scratching their head wondering why they're not getting any leads, and why they're not getting any applications and everything else. And it's just like it takes managing the manager and actively managing and knowing what you need to manage as well, so
Yeah, 100%. Trust and
yeah,
verify, right? Trust but
yeah,
verify is the other piece. It's like, hey, I'm doing this. We similar story. We couldn't get leads. Well, the phones weren't working. So the phones were getting rerouted. So I had people on my team calling the
yeah,
office to make sure. Plus, we wanted to see what was that conversation like,
yeah.
right? If I'm a potential tenant, is that a good experience or not, right?
Yeah, I had a similar one. This was about a year ago where, people were touring, they were liking it, they were getting to the application phases and nobody was finishing the applications.
Mhm.
I did the same thing. I'm like, send me the application. I think I ended up paying the $35 application fee just to see if it was working, but I got all the way to the end and it wouldn't let me submit it.
Yeah.
And it's just like, hey, property manager, I think I found your problem, it took them a week to find the bug and fix it. But yeah, it's one of these things where as the asset manager, as the ownership, you've got to make sure that you're inserting yourself and finding these things, before your occupancy gets down to that point to where you're in that oh crap moment. But
Yeah. Yeah.
yeah,
Because it's tough to come back from those. So
yeah, it is. It is. It's like digging yourself out of a hole, at
yeah.
that point. It's just, can you actually dig yourself out of a hole?
I don't know. If you have a shovel, you can maybe
Maybe if
dirt
you're,
in to get out, right? Just
yeah, I guess. Yeah, dig from the side to build up, I guess. Yeah,
something.
anyway. All right. So let's talk about how you guys went from, first deal. What were kind of the next steps, what did like 2020, 21 look like for you guys as far as acquisitions? Did anything change? Were you still looking in the same areas? What went on from there?
Yeah, so got the first one in Las Cruces, New Mexico, kind of middle of nowhere. A lot of people don't even know where it is. It's a great little vibrant market. New Mexico State's there.
Mhm,
And so, we got on the radar now of some of the brokers we had been calling.
mhm.
So now they're like, first, congratulations. Two, what else are you looking for? And
Yeah,
so that was a refreshing feeling because it flipped on us, right? People were, hey, these guys can execute. And I think that's another thing to take away from folks is your credibility is one with investors, but credibility with brokers, ability to close is a huge thing.
it is.
It might be the more important than the price. It is more important than the price.
Yeah, we just transacted with the broker and he sent us another deal. And he's like, I've already told these guys, you guys are going to close. He's like, I told him you just transacted. He's like, all I need is an LOI from you and we'll get this deal locked up.
Yeah.
But yeah, that is underestimated. It's absolutely crucial and huge there.
Yep. So being able to prove that. So we were looking at Albuquerque, Albuquerque deals starting to send to us. So we ended up buying two more deals in Las Cruces
Mhm.
in the end of that year. And
Okay.
then being based here in Phoenix, we were looking at development projects. Think I talked about that. So we bought a piece of dirt, 10-acre piece that we're still in the process of going vertical on. Spent the last 2 years doing entitlements. So, value add is I don't none of it's easy. Value add is simpler because it's an existing building.
Yeah.
Taking a piece of dirt and turning it into something is a lot more complex. And
Mhm.
so we brought in expertise to do that. So we've been spending time on working on those two projects is going vertical on a multifamily deal. And then we
Yeah.
bought in San Antonio, we bought in Albuquerque eventually. So it was really just building up slowly as deals were coming in. A lot of
Mhm.
that stuff happened in 21 and 22.
Mhm.
As you know, 22 was a frenzy year. And so, being careful not to just get too excited and buy anything, right? That was
Mhm.
the one thing we were blessed, and maybe it wasn't blessed, it was guided. None of our
Mhm.
deals had floating rate debt,
Oh
except
gosh, love that.
one
Love
floating
that.
rate debt deal. One
Mhm.
deal we just refinanced last month.
Mhm.
And we were only able to refinance because we were able to drive the NOI. Because as you know, cap rates have expanded like crazy. So what we paid for the deal, we're actually almost half a million over, 10% over what we paid for it, which
Yeah.
because of NOI, creation. But it was a little nerve wracking there, man, to be honest.
Oh yeah. Oh yeah. And I was very fortunate. I don't. I wish it was me, my intelligence and my foresight, but we had all fixed rate loans. My first variable rate loan we closed late in 2022. After most of the interest rate hikes had already hit.
Yeah.
And by the time we signed the papers on that loan, it was just like, I mean, most of the damage had been done. We'd already gone from like SOFR zero. I think we were at like four-ish,
Yeah.
when we signed that one. And it was just like, all right, most damage has been done. If we can make it work right now, we can make it work. But yeah, glad you guys didn't have, too big of an issue on the loans at least. That's where most people tripped up. I,
And some people are paying the price right now.
Speaking of, I was looking at some stats the other day. A lot of times when I plan my LinkedIn posts, I do actually research stuff. But 2022, the first half of 2022 was on track to break the record transaction volume. And so the first half of 22, they were head and shoulders above where they were in 2021. And then as soon as that rate hike cycle started, it was almost like the tale of two cities. It's
Yeah,
almost like two completely different years between, January through June and then July through December. But anyway, yeah, that was a very, very interesting year to be involved.
for sure. For sure. And thank goodness our properties are stabilized. We have one property we're kind
Mhm.
of like you described, right at that, right below cost break even, right? We're working through that one and it's challenging. Those are the things that we spend a lot of energy on and it's all good. We'll get it right. We have a good team, but
Mhm.
sticking to it. But having that fixed rate loan keeps one less thing off the concern.
Yeah.
So,
Yeah, and it's with your loan changing every month. And I learned this from my parents. I remember when my parents bought the house they were in. I mean, it was 1980s, so interest rates were a lot higher than now. And I remember my mom telling me that they had a variable rate loan, and had just gotten kind of interested or in finances and things like that. I remember her telling me, well, our payment is different every single month. If interest rates go up, we pay more. If interest rates go down, we pay less. And I just remember walking away from that conversation with my mom thinking, wow, that sucks. What if,
right.
and I asked her, what if interest rates go up a lot? She's like, then we pay a lot more. And I mean, this was like 10-year-old Brian, but I think I've always been reluctant to hit the variable rate loan button because of that. But
Maybe that, yeah, 10-year-old, it stuck with you, man. Right.
yeah, and glad it was a valuable lesson that stuck with me and not not my 10-year-old brain misunderstanding stuff. But
That's why
um
interest rates were like 12 to 14% too. So,
they were really high. And I remember you mentioned your first flip was 2007. My first purchase, it was supposed to be a buy and hold, was also 2007. And interest rate that I had on that loan was 6.5. It may have been like 6.75. But I remember thinking that was a really good rate. That's because of, what we had seen in the 80s and 90s and early 2000s. But anyway, it's all relative. But anyway, back to you. I got to get off my soapbox. So after we come into the rate hike cycle, you've got a handful of properties, fixed rate loans on all but one. How have you guys been managing things since the rate hike cycle began?
yeah, just again, honing in on operations. I think that's what a lot of folks did is look internally, right? We kind of paused on looking for new deals. Just again, I think the last deal you and I partner with that's the Tulsa project. That's our last value add acquisition, and everything
Yep.
else is just looking in house. Where can we find efficiencies? Again, everything was fixed rate except the one we worked hard. It took us 6 months to refinance. Got that thing done, and now we could breathe a little easier. Our investors are going to start earning distributions, so it's focusing on the investor relations piece. I think honestly, I would say, one critique is we lost a little bit of traction communicating regularly with investors, minus
Yeah.
the updates that we provide, but reaching back out, seeing what they're up to and how they feel about the market. That's really all we've been working on the last year and a half. And going forward, we're going to continue to do that and look for a few value add deals and get our vertical project up and running. That's
Mhm.
it. That's really it. Trying to keep it simple.
Yeah, keep it simple. So what are you forecasting is going to be happening in the multifamily space? I mean, pull out your crystal ball for a minute and
Yeah. Let me work that up a little bit. I mean, I
yeah.
think you're starting to see some signs now is the loan maturity piece, folks getting in a little bit of trouble. What I believe people thought would happen would everything would be on fire sale, right?
Mhm.
And that's not true because I think if that happened, a lot of things would collapse.
Yeah.
And so the banks are calling the existing operators that they have relationships with, and they're doing deals off transaction where I'm not necessarily seeing them. Maybe you're seeing them, but I'm not getting as many phone calls as I'd like. So we'll hit a point, I believe, where some of those deals are going to have to go to market. We've seen some big operators here in Arizona, but they have gone back to the bank. How those get repicked back up at what price? I mean, the LPs get wiped out, right? So if you got a $50 million deal with 30 million in a note, 20 million of the equity is gone. That's a great day to buy if you have the capacity. So Michael and I, our focus is really honing in on some larger equity groups and really creating relationships. When the time comes, we're not out syndicating trying to find 200 investors. We want to find 3 or 4, write a check, and let's go buy a deal and let us run it. So
Yeah, I love that. I do agree. I think right now, even if you're looking for deals, they're a lot harder to find now. We talked about, 2019, you had to underwrite 1,000 deals. I'm looking in Salt Lake, there's not 1,000 deals for sale right now. There's
right,
not a
yeah,
100 deals for sale.
right.
The calls we're getting from brokers, this property that I was alluding to earlier, guess what? We underwrote that a year ago and it's still on the market. So I think you make a really valid point. Now's the time to build the relationships. Now's the time, to build relationships with investors to prepare for what's coming. If you can get a deal here and there, go for it. But yeah, now's the time to prep for that. And I think that's wise. And when it's game back on, I mean, you'll be far ahead of the other people.
I mean, there's billions and billions of dollars on the sidelines, right? I know a lot of folks are concerned about November. I think that's been part of the challenge too, is the election does play a role in sentiment. And so, that being one of the pieces of, hey, let's build strengthen relationships when the floodgates open. I don't know if they'll be fully floodgates. I think there'll be some things trickling through and then maybe it'll go, but there'll be some time to buy. And I think we want to prepare for that. So that's an important piece for us. And
Yeah.
again, the other side is really sharpening up everything we have in place and being the best operators we can be. The one thing I think I say we're different, but we actively manage our deals. We're not like a fund of funds folk. And so I'm on the phone with PMs every day if need be. I'm on site with one of our properties. I'm on site every month. And
Yeah.
that's in San Antonio because we are fiduciaries of our investors' capital, our own capital.
Yeah.
Right. We also sign on the note. So there's a big loan behind it. And so failure is not an option, but optimizing and maximizing, where you can, that's what you do, right? And that's the fun part, right?
Yeah. Yeah. It is fun visiting the properties too. We closed on one in July and we were out there last week. First time as ownership on the property. And it was, like I said, it was fun. But, get on the property and it's like, okay, now we're not talking hypotheticals.
Right.
Now we're talking, we're going to change this stuff right now. But yeah, I mean, fiduciaries on investor money, I wish everybody had that attitude. I know a lot of people do, but I know there's a lot of people that don't. And I think you were alluding to one of the operators in the Phoenix area. I'm pretty sure I know who you're talking about. Probably rhymes with rides or something like that. But
Like that. Yep.
not that we were going to blast somebody publicly. But
No, and again, how they operate. I know who those guys are, and it's unfortunate.
yeah,
What's really unfortunate is those LPs, right? And so we take that probably the most serious thing. I'd rather not buy a deal. If something goes south, the first thing we do is communicate with our investors. We have a deal for right now. It's a development project. The costs are 50% more than what we anticipated. 50% more makes that deal really hard to pencil. So what do? We sent a note out, and yeah, we have some investors that are upset, but I would rather tell them what's going on and go, hey, here's our plan to fix it, right? And here's what we're doing. And at the end of the day, I would rather give you your capital back and not make anything, but give you your principal back. I'd rather do that than to lose your capital. So
yeah. And I mean, when we look at the foreclosures, and like you said, there hasn't been a tidal wave like a lot of people were expecting, which is fortunate. But foreclosures like that are bad for the entire industry. A company losing, thousands of units to foreclosure is bad for the industry. Money is evaporating. People who are LPs, well, I'm not going to say victims, but they knew what they were getting into.
Yeah, heavily impacted. And again, all investors know that there's risk, right?
Yeah.
But when you see these large properties, the last thing you can think of is like, what's it going to take for this to get turned over to the bank? Well, floating rate debt is number one thing that can happen, right?
Floating rate debt, high leverage, and not being able to operate. I mean, those are the three things right there that'll kill you. So if you can mitigate 2 out of the 3, you'll probably be okay. But
and it's a long run thing. We don't buy to flip. That's the other thing. It's a 5-6 year hold. So that should work its way through cycles. And, we tell our own investors, and sometimes we've had to say no to investors. Yeah, they want their money back in 3 years. I can't guarantee you that. I just can't. So,
yeah. And that's what I like a lot. I like the educated investor. I like the investors who know what they're doing. I was talking with one a couple of weeks ago. He's a good friend of mine and has probably put mid to upper 6 figures into deals I've done. And He's got money in a lot of different deals. And what he said to me really stuck. He's like, I'm okay with market risk. I put money in and I know if the market goes south, I'm gonna lose money. He's like, what I'm not okay with is the operators who don't have integrity. And I loved how he put that, and I think that's, if you're investing in stuff like this, you've got to understand that there is market risk, but you've got to understand there's sponsor risk as well. And the integrity piece goes a long way.
For
So
sure. For sure.
yeah. But cool. All right. Well, we're almost out of time, so start wrapping it up here. How about this? What's next for you?
Next for us. So, we're at, call it 700 doors. One of the things that we always heard about, I want to hit 1,000, 2,000, 3,000 doors. We're not a door company. What we really want to think about is where are we most comfortable,
Yeah.
and where are we having the most fun? So right now is kind of our stressful period as we get things out. We want to do one development deal a year and buy 1 to 2 multifamily Class B. So we've changed our metric and going from C to B type of asset twice a year. So 2 of those a year and 1 development deal. That's what we want to do for the next couple of years, 4 or 5 years. I'm 46. I have a young family. I want to go out and travel and just have things more automated and have folks kind of helping us out. So we don't want to be a big corporation. We don't want to go vertically integrate. We like what we have, and we want to stay in the markets that we're in. So we're really not looking to grow into a bunch of different markets, and just stay in multifamily, a little bit of development, and that's good.
Yeah, I smile when you said going from C to B, because I think that tends to be the trend. Once people are in the market for a little while, they're like, you know what, I'm done with that C class. By the way, C class is a great place to start out. It's a little bit easier to buy, but C class comes with C class problems.
Yeah, point of entry, it's great, right? But
Yeah.
it costs, returns, all that stuff. But you start to elevate your tenant base. The real thing is the vintage, right? Vintage of these properties is sometimes that'll kill you. We have a 1960s asset that's kicking our butt, right?
Yeah.
Well,
I've got the oldest property I've bought is 1920s. I've owned 20s, 30s, 40s. I've owned assets in every decade except for the 90s, between the 20s and I haven't done anything in the 2020s, but 1920s to 2010s. I've owned something
wow,
every decade besides the 90s. And you're right. I mean, the older assets have a different set of problems, and a lot of the problems are unseen. A lot of the problems are behind the walls. They're the things that you're not going to find during due diligence,
right,
and when they happen, you're bringing out jackhammers to get through the concrete, access sewer lines, and it tends to be a lot more expensive when you have problems on the older properties. But
right. And it's really hard, to your point, due diligence. It's hard to estimate what some of those issues can be.
yeah,
And so, those things come up, and so being prepared and trying to, work through those. So yeah, we're trying to mature and stay in the B class space a little bit. 1990s, 1990s product is now 35 years old, which makes me feel really old.
I
But
know. Well, I'm about the same age as you. I just had my 30th high school reunion last week. So,
awesome, man. Did you
yeah,
go?
yeah, I did.
I did. Okay, very cool.
I actually remembered a lot of people too, which is crazy. But
That's awesome. I think mine's coming around. Yeah, not too far.
yeah, yeah. So, next question. If you were to give some advice to somebody who's just getting started or just contemplating getting started in multifamily, what would that advice be?
2 things: reach out to as many operators as possible, get a feel for what's out there, passively invest if you can,
Absolutely.
understand what it's like to be on that side of the equation. It's the most important place to be, and figure out your skill set. Like, what can you bring? Because bringing value to a team, like if I want to partner with you, Brian, what skill sets could I bring to you that you need? Right.
Yeah.
So really digesting and understanding what you can do and how you can bring value to a relationship is the couple things I'd look at.
Yeah, nice, nice. Yeah, and you talk about being the passive investor. Remember when I started, I had enough money to either invest passively in a deal or get coaching. Out of the two, what would you do?
Oof. So I did both. Okay. I was
Mhm.
blessed to be able to spend
Yep.
a big chunk of change on coaching.
Mhm.
If we didn't do the coaching, we wouldn't be where we are.
Yeah.
For 2 things, not for the education that I got, but for the
Mhm.
people that we met.
Yeah.
Our sponsor, my partner, I found through the coaching program.
Yeah.
So I would do that again, and I would probably spend double that because I made it back on my first deal, right?
Yeah.
And
Yeah.
it's been delivered tenfold.
Answer for me is I went and I paid for the coaching and I don't regret it. I think same thing. That's paid off almost 100-fold by now in 6 years. Almost 100-fold in 6 years.
That's
So
amazing.
one $50,000 investment into a deal wouldn't have done that. All right. Last question. How can listeners learn more about you?
Yeah, check out our website, nimblecapitalgroup.com. You guys can call me on my cell phone. Do you want me to give you my number? I'm happy to give that out.
Yeah, please do.
It's 909-730-5096. Mike Angelo, reach out to me. I challenge you to reach out because again, I was you on the other side and I called operators that challenged to take, make the phone call
Yeah.
and happy to spend some time on the phone.
I did the same thing. And no, by the way, if you rewind this about, 60, 80 seconds, he did say contact as many operators as you can. So there you go. Best place to get in touch with me, and you can reach out to me as well. LinkedIn, send me a note on LinkedIn. So, and that's where I will respond 100% of the time. So, all right, cool. Well, that said, thanks for coming on the show, Mike. Very much appreciate your time.
Yeah, thanks for having me, man. It was a blast.